earn just $1 over 400% of the federal poverty level in 2026, and a middle-class family of 4 could be forced to repay up to $10,000 of ACA subsidies they thought were free, according to health policy analysts cited by CNBC. That money already went to your insurance company months ago, but the IRS treats it as a loan that comes due at tax time. Stick with me, and I'll show you exactly how a discount turns into a debt. I read the fine print, so you don't have to. Here's the truth most people miss. The ACA discount is really the advance premium tax credit, and the government pays your insurer upfront based on the income you estimated when you signed up. Your real year-end income decides how much you were actually entitled to. And if you guess too low, that gap becomes yours to repay. When you enroll, the marketplace runs 3 inputs: your projected annual income, the price of the benchmark silver plan in your area, and a required contribution percentage set by law. Together, those decide how big your monthly subsidy is. But notice the weak link. The whole calculation is built on an income figure you're only guessing at in advance. Most people take the credit as an advance, which means the IRS wires money straight to your insurer every single month. Your premium just looks smaller, and you never touch the subsidy yourself. That invisibility is exactly why the shock at tax time is so brutal. You spent money that was never really yours to keep. The system expects you to chip in more as you earn more. At the poverty line, you pay roughly 2% of income toward the benchmark premium, per KFF Health News, but that rises to 6.60% at 200%, and 9.96% once you're between 300% and 400%. So as your income climbs, your subsidy shrinks. And if your income rises after enrollment, you've been quietly overpaid. When you file your federal return, Form 8962 reconciles 2 numbers: the advance credit the IRS paid your insurer all year, and the credit your actual income says you truly earned. If your real income came in higher than your estimate, that gap is called excess APTC. And that excess is added straight onto your tax bill as money you now owe. Here's the trap that catches so many families. The subsidy doesn't taper off at the top, it falls off a cliff. CNBC reports the 2026 thresholds land near $62,600 for a single filer, $84,600 for a couple, and $128,600 for a family of 4. Go even $1 over, and you don't lose part of your subsidy. You lose every single dollar of it. The subsidy doesn't stop automatically when your income rises. A bonus, extra overtime, or a spouse going back to work can push you over the line while the marketplace keeps paying your insurer on the old lower estimate. You can accumulate months of ineligible subsidies before you have any idea you cross the threshold, and every month adds to what you'll owe. Before I get to what this means for you, here's the most counterintuitive piece of the whole thing. For over a decade, there was a legal cap limiting how much excess subsidy you had to return if you misjudged your income. Starting with 2026 coverage, that cap is gone entirely. There is now no limit. You repay every dollar of excess APTC, whatever the total. Take Jason, a project manager with a family of 4 who enrolled expecting $120,000, then earned bonuses that pushed him to $130,000, just over the roughly $128,600 cliff CNBC cites. Because he was over the line, he was never eligible for a cent of subsidy, so he repays it all. His discount plan was really a deferred IRS bill, and experts warn cases like his can easily reach around $10,000. Here's the move that protects you. Log into your marketplace account, add up your actual year-to-date income, including any bonuses, and compare it to the 400% threshold for your family size, roughly $128,600 for a family of 4 in 2026. If you're anywhere near that line, report the income change so your subsidy is trimmed before the excess piles up. If this is useful, subscribe. The next breakdown is already coming. Don't wait until April to find out. Pull the IRS Form 8962 instructions, plug in your projected full-year income and the advance credit already paid to your insurer, and estimate whether you'll owe excess APTC. If the number comes out near zero, you're aligned. If it's large, you still have time to update your income or turn off the advance credit and avoid the five-figure surprise. The ACA subsidy cliff is only one of the traps hiding in your health coverage. Next, I'm breaking down exactly how insurers calculate the benchmark silver plan that sets your subsidy, and why choosing the wrong plan can quietly cost you thousands. If you want to catch that, subscribe so you don't miss it.